Good morning, everyone, or good afternoon or good evening, depending on where you are in the world. Welcome to today's webcast on the growth of fintech and wealth apps and the role of big data, brought to you by VentureBeat and Yodlee Interactive. My name is Dylan Tweeney. I'm the editor-in-chief of VentureBeat, and I'll be your moderator today. We have just a few announcements before we begin. I want to go over some logistics here. So on the next slide, you'll see some of the details here. Please enable pop-ups on your browser, use your headphones, or turn up your system speakers so that you can hear me. And you'll be able to submit questions or comments to the presenters at any time during this webcast. And just type your question into the Ask a Question area in the video window and click the Submit button. We will queue them up and answer them as we are able to. The webcast will contain some audience polling. So the polling questions will appear in the presentation window. Please complete the poll when it appears and then click on the Submit Answer button. If you do this relatively quickly, we'll get answers quickly, and then we'll be able to show you the results immediately on the next slide. The slides will advance automatically throughout the event, and you may also download a copy of the slides if you wish to by clicking on the Download Slide button located below the presentation window. If you're experiencing any technical problems, please visit our help guide by clicking on the help link below the media player. In addition, you can contact our technical support helpline, which is also located in the webcast help guide. Now on to the panel discussion. Our panel of experts today includes three excellent gentlemen. Mitch Tuckman is Managing Director at RebalanceIRA.com. Mitch co-founded Rebalance IRA as a way to support baby boomers in their efforts to achieve and maintain financial security. Rebalance IRA leverages the same proven investment methodology and low fee structure and includes access to a dedicated investment advisor for every client. He has 25 years of experience in venture capital, public finance, and technology. Next, we have Stéphane Dubois, the founder and chief executive officer of Xignite. Stéphane is a recognized software and market data industry executive and innovator who founded Xignite to pioneer market data in the cloud. Today, Xignite is known for creating the industry's only pure-play market data cloud platform used by clients around the world across a range of industries. And he also has deep experience in software and in investment arenas. Our third speaker today is Joe Polverari. He's the Chief Strategy and Development Officer and the Managing Director for Yodlee Interactive. In those roles, Joe is focused on making the Yodlee platform available everywhere that value can be created by entrepreneurs, partners, and developers building digital financial apps and services. And he's been a member of Yodlee's executive management team since 2000 and had a long and distinguished career before that. So now let's go to our next slide. We're going to do this discussion in basically 4 acts. First, we're going to talk for a little bit about how fintech is exploding. And then we're going to talk about the growth of wealth management, fintech, and the availability of big data. Our third act will be discussing the cultural shift led by millennials and their profound distrust of traditional financial brands. And finally, the future of wealth management apps we'll talk about in the last 10 minutes or so. First, we have a poll, though. You should see this on the screen. Do you believe traditional wealth management services are at risk of disintermediation by non-bank service providers? Give that an answer. Pick an answer and click the Submit button. And I'll give you another minute or so, and then we'll advance to the next slide and look at the results. I'm hoping that this presentation will be a nice interactive discussion between and Joe, and I will do what I can to facilitate it and throw in audience questions when I can. I'll set up the discussion and then throw it over to these guys who are far more experienced in financial tech specifics than I am, but I'll throw in some questions of my own as they come up as well. So let's go to the next slide and see what the results are. It looks like nearly half of you, the plurality, 49%, believe that traditional wealth management services are at risk of disintermediation, and only 10% voted no. So that's kind of interesting. A number of you are a bit more cautious, saying maybe this will happen within the next 5 years, and a smaller number within the next 2 years. So it sounds like guys, we have an audience of people here who are cautiously optimistic about the possibility of disintermediation. Actually, I should say, I don't know if that's optimistic or not. It depends on your point of view. If you are a traditional banking service provider, maybe that's a slightly pessimistic view. All right, let's get into the discussion now. Our first act, FinTech is exploding. And if you could advance the slide, we have some information on this. First of all, there are some significant macro trends that are rapidly reshaping the financial services industry. And as a consequence, it's more focused on technology innovation than at any other point in its history. In 2013 alone, FinTech companies raised nearly $3 billion in venture funding, more than tripling the amount invested in FinTech in 2008, which was $930 million. So there are all kinds of new and disruptive FinTech technologies out there changing banking relationships and putting pressure on traditional wealth management firms and financial institutions. So here's my question for the panel. What does the future of wealth management look like in general and or from a tech perspective, and what do you see driving this growth? So Joe, Stefan, Mitch, I'm going to throw it to you now. I'd love to hear your thoughts on this.
Great, thanks. This is Joe. I'll just kick off since you asked me first. I think we all remember stockbrokers, right? Those of us who are old enough. And I think what we're going to see as we get down further in the wealth management track as it evolves is the same thing that happened in stockbroking in general. You used to have a very high-touch, hands-on service where everyone had a broker or brokers that serviced them personally, and it very quickly, in a matter of years, was disintermediated. I think the same thing is happening and beginning to happen with a lot of regularity in wealth management across the board. And I think the things that are driving that today, at least the things we see, and we've got several hundred companies that are in the wealth management space on our platform today, what I would consider financial innovators. I think it's basically the consumer drive for transparency and control of the process. Maybe not down to being entirely self-directed, but having more transparency, more control over the process that affects ultimately their financial and overall well-being. That drive for convenience and control is going to, I think, very quickly lead to an even greater disruption than we're seeing today.
Yeah, this is Stefan. I don't disagree with that. I think one question is, why is it happening now, right? And at this exact time, because certainly FinTech is on fire. I think in October there was more than $1 billion raised by various FinTech companies, so that's probably the biggest month ever, if you want. So the way I look at it, it's a convergence of three trends. The first one is an economic trend. The markets are back to their highest level in history. And when you have a bull market like this, certainly it helps resurrect something that hasn't necessarily been faring so well since the mortgage crisis. Then you have a social dimension to it. And the social dimension is the fact that you have a brand new generation of people who've grown with mobile, who've grown with a fast-growing market, and who are looking for different things, which is what Joe was talking about. So specifically, we talk about millennials, and we'll come back to this in a minute. But it's a very different situation from what we had, for example, in 1999, when there was a first bubble, and there were talks about the internet disintermediating wealth management and banking, and it didn't happen then, right? But now it is happening, and the primary reason is because we have a whole generational replacement. And the third reason is a technology issue, a technology reason. What we've had over the last many years is a growth in the area of the cloud technology, which is really giving technology companies an advantage from a cost structure standpoint compared to traditional companies, traditional banking organization. You have the availability of APIs and data, and we'll come to that again, that is also enabling automation of a lot of aspect of wealth management in a way that was not possible before. So if you combine a high market, a brand new generation of people with high expectation and a technology that enables a brand new generation of FinTech services, you have the ingredients required to essentially fuel that FinTech fire.
Stefan, I want to cue in on a couple things that you mentioned there. One is you said $1 billion were raised by fintech firms in October of this year alone, which suggests that the rate of investment is continuing to accelerate even over 2013, when the whole year last year saw $3 billion. So that's interesting. The other thing you said is that this is tied in part to the sort of, the economic boom coming out of, the mortgage crisis and the issues that we faced in 2008, 2009. So my question is, we saw a similar thing happen in '99, where there was a surge of interest in sort of new online financial services like E-Trade came out of that. My question is, will this boom or will this interest in alternative fintech companies survive, longer than say the economic boom might, or is it tied strictly to things looking rosy?
I think the parallel with what happened with the internet wave in the 90s and E-Trade is very, very relevant. What I think is going to happen is we're going to essentially see digital wealth management taking another slice of the overall advisory market. Right? It used to be back in the 60s, 70s, you only had traditional investment management, traditional brokerage. And in the 70s, you had Schwab coming around with discount brokerage, and that took a chunk out of the market. Right? And then in the 90s, you had E-Trade and TD Ameritrade and the others coming in with online brokerage, online advice. That took another chunk of the market. And I think what we're going to see, and it's going to last, it's not going to take all of the market. It's not going to disintermediate everyone. There's still going to be, the previous models will continue to exist, but they're not going to see the growth. The growth is going to get captured by digital wealth management. And you can fast forward several years, and you're going to see that digital wealth management is going to represent what what online brokerage is today, if you want, right? It's the next generation.
Yes. An audience question here, and it's a definitional question. I want to get to it before we go much further. Somebody is asking what our definition of fintech is, and whether we're speaking about companies like Betterment, Wealthfront, SigFig, and so on. Do you guys want to take a whack at defining fintech?
I could take a whack at that. This is Mitch Tuckman. It's a great question. I look at fintech as anything technology applied to finance, but the problem with that term is it could be applied to technologies that allow someone like me as a wealth manager to do my job better. So it could be all back-end technology for rebalancing a portfolio, for example. It could be a company like Betterment, Wealthfront, SigFig going direct to consumer with a wealth management solution online. It could be like Yodlee, which is a fintech company aggregating data for the financial services industry. It could be a new model like Lending Club, which is using technology to bring a lender with a borrower together. So I think the term of it is as misleading as the term software, for example. It depends on what your company's doing and where you're at. So I think the amount of money invested in quote fintech doesn't matter in the context of a conversation about disintermediation of wealth management, because that's a very specific form of fintech. So I would look at it that way. My approach to this conversation in this webinar is I deal directly with clients day in and day out, and I talk to people in their 20s, 30s, all the way up into their 80s. And I think that when we talk about this market, you have to start segregating the needs of people, because it's the people who have earned their money and are trying to invest it and grow it in the fastest way possible or safest way possible. And those people can be dissected between those who really like investing and want to get their hands on the wheel and do stuff, trade, monitor their investments, look at performance, and like this stuff, right? And that's a lot of people. And then there's a lot of people who really don't want to deal with investing. They make money. They want to have somebody take care of it. And frankly, they get a lot of negative emotions around the concept of investing. And Forrester calls those people delegators. They call the former group soloists. Then there's a group in the middle who don't really know much about it, but they want to do it themselves, and they don't want but they don't know anything, and they want advice, and they want to be advised, and they're called validators. They want to do it themselves with validation. And so when we look at the world, we look at those three groups, and then we dissect it by how much money they have, and you get into various other segmentation issues, which really defines how the fintech industry will sort out in terms of how it solves various groups or problems.
So, Mitch, hold that thought for a few minutes, because we're going to come back to segmentation, I think, when we talk about millennials and how their approach to fintech may be different from other demographics. That'll be in our third act, I think, in about 10 minutes.
Sure.
First, I want to ask, sort of a general question. I mean, traditionally, financial institutions have looked at technology in a very security-first kind of way, right? I mean, there's nothing more important than ensuring the integrity of a bank's financial information systems, right? Security is paramount. With the shift to kind of new models of providing services, obviously security is still important, but there's another dimension of sort of innovation and user experience and usability that become important. How do you continue to provide that sort of that security assurance in a world where convenience is also and usability is also very important?
I think what we're seeing with large financial institutions, especially because they're certainly seeing the emergence of the wealth front and personal capital and betterment of the world as a threat. I think today Wall Street is very scared that Silicon Valley is going to eat its lunch. So many firms are therefore trying to react and trying to address the problem, and they feel that over the last, since the mortgage crisis, there's been very little innovation made by large financial institutions, essentially opening the door for startups to come in and reinvent many elements of finance. Now, faced with that, I'm seeing two types of reactions from large financial institutions. You have those large banks who are known as systematically important financial institutions. They're very, very large financial institutions, highly regulated. Those are probably going to take a very, very conservative approach to things and not necessarily rush to try to emulate and do something similar by providing advice online. However, you have other institutions that are trying to catch up. Many of you have heard about what Schwab is trying to do, and they've announced something that they're planning to do in this area. Fidelity has partnered with Betterment to try to also play in the game. So I think those firms are taking a much more advanced approach, if you want. And for that reason, I think security is not an issue for those. It's something that they're willing to tackle with.
Do you think that's the case, even given the rash of sort of well-publicized hacks into various systems that we've read about in the past year? I mean, is this not a concern for consumers that companies have to address?
Oh, no, it is a concern, especially if you're one of these very large banks who are extremely exposed. And for those, you're not going to see them starting to provide and to put all the data in the cloud and things like that, because you cannot dissociate what is happening in fintech from the emergence of technology like the cloud, right? If it would be hard for fintech companies to do exactly what the bank are doing the same way they're doing it with the same cost structure. So if the large financial institutions want to compete, they're going to have to also start adopting those technologies. And the heavily regulated institutions are going to be not doing this very quickly, while some of the less regulated ones are going to try to figure out how they reduce their own cost structures.
Okay.
So let me just jump in there for a second. This is Joe. I've got a little bit of a different perspective. And we've been working on Yodlee for about 15 years now, and we started and still predominantly work with banks in terms of, if you look where all of our users come from, or most of our users come from. And so all of those banks, 100% of them that are on the Yodlee platform, have adopted the cloud wholeheartedly. That's the only way we offer a service to them. So they've gotten themselves comfortable with it. I think the trick has been, because it's such a serious topic, right? Your money, and where is it, and how do you deal with it, and how is it safe? It's taken much longer to innovate and much longer to make progress. If you look at the rest of the internet and you think about what you do, you search, you shop, you communicate, and you deal with your money. Searching, shopping, communicating that's relatively manageable in terms of bad things that can happen with data. Dealing with your money and managing your money and planning for your retirement and things like that are much more serious, and I think there's an added legal and regulatory overlay that's governmental. It's also organizational from a financial services industry perspective, and ultimately it rolls all the way down to the entrepreneurs that we see in the market today. So I think the issue of security is such at the top of everyone's mind that it's necessarily slowed innovation, but now that's changing. And the problem is, for consumers, like all of us are, it doesn't happen in weeks or months. It's not as simple as just starting Facebook and building a platform. You actually have to weed your way through legacy business models, legacy regulatory schemes, and many other complications just in the U.S. It gets twice as complicated when you get outside the U.S. To get things done. So that's why I think we've seen a relative lack of innovation, but it feels to me at this point, we're on the path to catching up.
Okay. You make an interesting point, which is that, if Target reports that it's had a massive, breach and a bunch of credit cards are stolen, for me, that's not a huge deal because, as a consumer, my liability is extremely limited because the credit card company covers that cost. But if somebody hacks into, my bank account or my stock trading account, that's a much more serious matter. Let's segue to the role of big data in wealth management fintech. One of the keys to massive growth in the investment in this sector is the availability of reliable and real-time investment data. Of course, financial markets themselves generate massive amounts of data related to securities, equities, IPOs, and other kinds of trading, and startups and those looking to capitalize on the impact of data, can aggregate that data and use it in a variety of ways. And it's also given rise to a new technology-driven, a host of technology-driven wealth management competitors. So my question is, what is the role of big data in this industry, and how can it help make fintech more competitive, more appealing, more powerful for a new generation of tech-savvy consumers?
Sure. Let me take that one. I think data. I mean, a big theme in digital wealth management and fintech is automation. Right, and it talks to the generation of millennials who are not necessarily wanting to invest and do all their decisions themselves, being like the self-directed people that Mitch was talking about, but they're not necessarily willing to delegate to somebody else and talk to somebody else. They want something that's very automated. And the thing is, now we have technology that makes it possible to automate a lot of the investment process. It's not for everyone, but it's possible. And some of those things would be like ETFs, exchange-traded funds that provide us an easy way to invest into a diversified strategy, if you want. Of course, you have things like the availability of account data, holistic account data, which is what Yodlee, for example, provides. 10 years ago, if you were a financial advisor, it was very hard to be able to consolidate all the holdings information of your customers. Now you're just an API away from this information. Same for market data. Market data is where Xignite operates. Market data is the lifeblood of finance. It's how a lot of decisions and executions are taking place. And although it's not a huge amount of data, it may barely qualify for big data. It used to be very expensive to acquire, very expensive to maintain and access. And now you have easy APIs available on the cloud that allow a company like Wealthfront or Personal Capital or Betterment to essentially focus on automating the investment process instead of worrying about how they're going to tap into that large data world. Having said that, there's a couple more tiers of big data that are very relevant today. There's social data, right, which is really where the quantity of data is very important. And what we're seeing is a lot of fintech companies building their models around social information, around identifying patterns among different users and what is happening in the market, the Twitter feed and whatnot, to be able to come up with recommendations and actions on how you should act into the market. I think that this area, the analysis of new data set, very large data sets like the Twitter feed, we have companies who look at satellite imagery, for example, to generate new actionable information. This is a little bit the new frontier of fintech. It's not fully matured, it's not fully normalized and categorized, and I think we're going to see a lot more evolutions in this area in the next few years.
Yeah, this is Mitch. Regarding big data, I think big data is the role of it is really where Yodlee plays. From a user standpoint, it's about performance data and trying to understand how is my portfolio doing. Can I aggregate information from various accounts, learn what my asset allocation is, learn all the technical things about my portfolio, and how it's performing. That's where these big data services are helpful at an end user level. But I think the biggest impact big data is having or going to have in this industry is really along the lines of social media and really more specifically customer acquisition. If any of the players like Betterment, Wealthfront, SigFig, et cetera, fail, and I believe there will be some failures, it'll be that they weren't able to acquire customers at a reasonable price. This is a customer acquisition game at the end of the day. The money management part of it, the robo investment management of it, that's pretty simple. That's not too complicated. But customer acquisition, acquiring a customer, what the price of that is and how you can grow your AUM, that's the critical part of this business. And big data and finding clusters and patterns of clients and potential clients, particularly Wealthfront's been most impressive at this with their ability to aggregate information about groups of millennials that are have similar likes and dislikes, and getting them to take the service and refer their friends and grow that way at a very low price. That's really where this big data concept is coming, but it's more of a marketing issue, not a financial data issue, in my opinion.
Mitch, something you mentioned there about competing on price, right? I mean, price is obviously a critical issue here, as in addition to usability and availability of things like mobile apps and mobile interfaces that help people do their financial management on the go. We got a related audience question a few minutes ago, which was if everyone ends up competing on price, is it a race to the bottom? Will we see a race to zero in terms of pricing in fintech services?
Yeah, I think if we're talking about the robo-advisors, I think the pricing competition is absurd. There is so much headroom out there with respect to alternatives. If you walk into Fidelity, if you walk into what we call old school brokers, and you give them, first of all, they won't even take $10,000, $15,000. But if you have $50,000, you're going to be paying 2.5% in fees all in with the funds that they're going to invest for you and everything. So by driving down 25 basis points to manage AUM that the robo guys are offering is insanely cheap. It's a great deal. If anything, they might want to look at going up a little bit, because I don't think this is about price. I think the end clients, it's all about trust. And so, do I trust the Betterment brand? Do I trust the Wealthfront brand? If I trust the brand, if I feel like I'm getting a good experience with the firm that I'm doing business with, 25, 30, 40 basis points is not going to matter relative to the alternatives. So yeah, I think this competing on price is to me it marks a lack of understanding of what the end clients are really looking for when they're looking for a solution for having someone manage their money.
Well, I think there's a rationale to that, right? First, the robo-advisors have a huge advantage over traditional finance, is because they completely understand what you talked about, Mitch, which is the customer acquisition cost. They're using social relationship as a way to acquire customers. And I'm hearing some crazy stories here. I'm hearing stories of kids who made several $1 million, selling their companies in Silicon Valley and putting millions or tens of millions of dollars on Wealthfront because their friends are there, right? So this is a very different world. You would have never conceived something like that, 10 years ago, that you would have, invested in an automated platform because your friends are doing it. And I think there's a fundamental change on how referral and customer acquisition is going to work. The other thing is the cost thing. I agree with you. Eventually, this is not about cost. It's going to be about building the trust, and we need to come back to that. But right now, because their cost structure is so low, because they're completely automated, they're able to have very low entry point, very low cost. Obviously, they have tons of capital they can throw at it to build the AUM very, very quickly. But they will have that low cost structure in the long term because they've automated things in ways that large financial institutions have not automated. Right? And the large financial institutions have much higher cost structures. They're doing things much more manually in many ways than those guys. And so they have a long-term cost advantage. They will be able to raise prices over time, but not until they have acquired all those assets, I think.
Okay. Let's talk about millennials next because that's our third act. Before we get to that, I want to pull up on the screen. And the question here is, do you believe that your firm has the tools, services, and technology needed to meet the demands of millennial investors? And please answer yes or no, or not applicable if you are not actually a financial services firm. I'll set up the discussion while you guys vote on this. It should be popped up on your screen at this point. Just click a choice and press submit, and in a minute we'll go to the answers. Let's talk about millennials, though. As the bubble of wealth works its way down to millennials, and Stefan, you mentioned the story about people who got lucky in Silicon Valley entrepreneurship and made a few $1 million or a few tens of millions from their startups. Those are certainly an interesting demographic to wealth management. They may be more of an outlier. I think they're sort of the leading edge, right? Your average millennial is not in that bucket. But I think it's certainly the case that we're seeing more millennials start to think about wealth management, preparing for retirement, or just saving money. And it seems that they may not have the same priorities as baby boomers. We'll get to that in a second. First, I'd like to see the results of this poll, so let's see if we can get that up on the screen. Do you believe your firm has the tools and so forth necessary to meet millennials' demands? Only 32% answered yes, and 25% answered no, and then about 42% of you marked not applicable. I don't know exactly how many people answered this poll, but I will say that there are 150 people on the call right now, so it's probably close to that, assuming most everybody answered the poll. Let's go to the next slide. And I believe there's a data point after this picture of some young, hopeful, hardworking millennials. They are seen as more conservative and less trusting of banks than baby boomers and Gen Xers. They don't have the same kind of, my broker is E.F. Hutton and E.F. Hutton says approach to trust of the old brands that perhaps their parents did. And they may be more drawn to emerging financial technologies. So let's talk about that demographic transition. I mean, Stefan and Joe and Mitch, how do you see millennials as an emerging market for wealth management?
Well, I think it's clearly a different population. It's all about instant gratification. It's all about mobile. It's all about automation. I don't know about you, but my kids have phone, but they never actually use the phone. They only use it for something else, right? And they use the apps. They don't use the phone itself. They don't even answer it. So the big question is, it's certainly a big demographic that has a fundamental different behavior. The big question is, as they grow up in age, are they going to go back to the old ways? Are they going to become more conservative, more wanting to, they'll definitely get more conservative about their investment, but are they going to want to talk to somebody? Are they going to want to have that trusted person with whom to have a relationship, or will they be able to develop a similar trust with a brand like Wealthfront or somebody like that, as they have built that trust with brands like Apple and Google and Facebook. I mean, to me, if those institutions offered financial services, I think a lot of millennials would trust them. So we'll see. It's definitely a different behavior. Will it last? Is it going to stay like that? It's going to be depending on how those millennials grow up, essentially.
Yeah, I think
what do you think,
look at it from
Mitch?
a marketing perspective.
Yeah.
Sorry, no, this is Joe. If you look at it from a marketer's perspective, they'll tell you one of the toughest things to do is change behavior, change consumer behavior. And right now, what you've got is an increasingly large group of millennials that are generating their own wealth and also having wealth transferred to them by their baby boomer parents. And the only behavior they know from a money management perspective is digital. So the nature of the conversation really for them is natural to have it occur in a digital construct instead of in front of a financial advisor or a banker. And to get them out of that, there's got to be a pretty powerful incentive, like something bad happens, which hopefully it doesn't, and it's likely that it doesn't. So assuming there's no catastrophic event, I think most people are going to continue on and happy to have their financial management and other digital financial services start to disappear into the background of their lives and just happen around them and for them. So I actually do think the millennials don't know any different, and therefore they will not behave any differently in the digital channel. They'll just continue to manage their money as part of their life within that construct. And that is very different to the baby boomers who are transferring that wealth down today.
There's a related question from the audience, which we got a little bit earlier, and it's quite relevant to the millennial question. This audience member wants to know where the biggest traction is among the demographics, and we'll say among the millennial demographic, mass affluent, or high net worth individuals, or ultra high net worth individuals. Where do you guys think the traction is for digital wealth management?
Yeah. Again, what we see across sort of the Yodlee network is everyone's very interested in mass affluent, and they perceive that to be a very underserved segment. And mass affluent, the definition we typically see thrown around is $100,000 or more in investable assets. Everybody is trying to figure out how to crack that code, because if you look at the pathology of a mass affluent customer, 1 out of 10 of them, 3 or 4 out of 10 of them actually grow beyond that category. So those are pretty good odds. If you're going to invest in 10 customers that are mass affluent, 3 or 4 of them might make it into your private banking sector, and those tend to be, from a bank perspective anyway, your most profitable customers by a long shot.
Well, the big question is, does it even matter, right? Because when you have a solution like some of what the digital wealth managers do, they with one solution they can serve multiple markets. I think many of them are targeted at the low end of the market today. But as I've mentioned some examples, some high net worth individuals will go for it as well, right? Because the service is automated in a fashion that it could actually fit multiple sets of requirements, I think.
We look at it, if we're talking about millennials, we look at it more like where people are in what stage of their lives. So I am a baby boomer. I'm in my late 50s. I remember when I was 30, I was paying off some school loans, hadn't bought a house yet. I was at a different stage in my life, didn't have any kids. We find that when people are sort of building their career, rolling up the hill, their money is not as personal and important to them. They're moving forward in careers. If they've got a few bucks to put aside, yeah, just somebody invest it for me, right? Are you smart? Do you know what you're doing? Yeah, just do that. But we call this an aha moment, generally in someone's early 40s, 43, 44, 45, and they hit this moment, and it's, the shrinks have lots to say about this, but you begin looking down the other side of the hill, and you think, well, 20 years ago I was 25, 20 years from now I'll be 65. How am I going to fund my lifestyle? You're looking at kids' college educations and all kinds of other things. Money and its place in your life becomes much more personal, much more important, much more significant. Are you going to let an algorithm make decisions on how to allocate your money? Maybe, maybe not. Maybe if you've been used to doing it, you might continue. But you might find that now you've had 3 jobs and 3 401ks that haven't been rolled over, and you have a spouse, and it's similar. And things do get very complicated. And money is here, it's there. Your financial affairs tend to look more like a yard sale than a nice little package of assets. And we just find that for people over 45, which is what our business is all about, and they are the mass market you described, Joe, they want a person to talk to. So there's a new layer. It's not just the investment management part that robo-advisors do, and we do it as a robo-advisor as well, but the investment management is very easy to automate and very easy to use an algorithm to come up with an allocation for a client. But there's a whole nother layer of planning, and that's where we think that a demographic of an older individual is going to need some guidance and hand-holding.
So, Mitch, it sounds like people might come in as, sort of wanting a more automated and digital solution, and as they evolve, grow older, and become more sophisticated, the company may want to provide some sort of transition to a more involved model that allows them to self-direct more and maybe interact with people a bit more.
Well, maybe the line is getting different. It used to be, do you have the time or the energy or the will to be self-directed, or do you want to delegate? All right? This is what Mitch was talking about before. Because the investment process was not automated. Right? So either you had to make your investment decision, do your research, buy your stocks, do your allocation, do all of that, or you would give it to somebody else who would do it for you. Right? And as you draw that line, you went from also dealing with technology to dealing with a person. Right? But now what you have, and we're just at the beginning of that, so I think it's going to get better and better and deeper and more sophisticated. What you have is automation of a good chunk of the investment the advice process. So now you have a line that would be, it's not necessarily self-directed or not. You can delegate to a system, in this case, the actual decision process of based on your risk profile of how you want the money to be managed, and that can change as well. That can evolve based on how you grew up and how your assets and your risk profile changes, without necessarily handing this out to somebody else to manage, right? So maybe now the delineation is going to be between whether you want to deal with a person or not, right?
Yeah.
And that's going to be a different line, and it's not just because you reach 40, 45 that you delegate. You can still reach 45 and feel that the automated system is right for you, and you still don't want to deal with a person.
Yes.
Yeah, that's a great point. There are going to, unlike most venture opportunities that we've all lived through in Silicon Valley for decades, where there's a winner-take-all. Is it going to be Facebook or Friendster? It's Facebook. Winner-take-all businesses. This business, there's going to be many, many, many winners.
Yes.
There'll be many successful firms because it's not a winner-take-all opportunity. That's another big point.
Let's talk about the future next, because we have 10 minutes for our last segment. Before we get to that, I want to throw one last poll on the screen. So let's push that to the audience. Do you believe consumers will begin to trust non-bank offerings like Apple Pay, Amazon, Google, PayPal, what have you, with services that help them better manage their finances? Please answer whether you think that's extremely likely to not at all likely. And then we'll continue the discussion in a moment about the future and sort of whether these demographic and technological trends are going to converge and create new opportunities for more innovative technology startups, and if so, what those opportunities are. Please place a vote and press the submit button. We're going to advance now to the poll results and take a look at what you guys think. So it looks like a good 80% of you think that it's extremely likely or very likely that consumers will begin to trust non-bank offerings, and I'm assuming that's in the near future. Only about 17 or 18% think that's slightly or moderately likely, and nobody is voting not at all likely. So clearly there's a lot of confidence in non-bank brands like Apple, Amazon, and Google in terms of being able to get a foothold in this market. Whether we can say the same for smaller brands or as yet unknown brands like startups is a good question. Let's advance to the next slide and take a look at our final discussion, which is about the future of wealth management. I guess, continuing the discussion, what sectors show the most promise to you guys in terms of where innovation can be enabled and quickly brought to market in terms of wealth management? What kinds of services or apps do you guys think are poised for growth in the next year or two?
I'll answer. I'll start with that. This is Mitch. But before, I just want to comment on the survey you just did. Remember, there's a very, very big difference when you use the term financial services that relate to how people spend their money and manage their budget, the money coming in debt and cash flow. We call that personal finance. Mint played in that, etc. As opposed to what we've been talking about, which is managing your savings and your investing. Mm-hmm. And those are very, very different markets and very different psychographics. So I just want to make that clear. Wealth management is all about investing people's hard-earned money, and it's very different than how they pay their bills.
That's a fair distinction. To step up on answering the question of where we see the evolution, I think what all the attention so far has been on the first wave, I would say. I mean, it's not a first wave of fintech. We've had things around payments, things again around lending that are happening as well, but certainly wealth management has come into focus over the last year very, very heavily, and that is the poster child for fintech right now. And we certainly will see, what we'll see is out of the firms that have emerged, there'll be some winners that will stand by themselves, I think. That will become the next E-Trades, E-Trades of the world, if you want. There's going to be some that will get absorbed by others, like the TD Ameritrade of the world, right? And there's some that will disappear. So there will probably be this new market segment being created called digital wealth management, will some self-standing companies, new brands, and some that will get absorbed and consolidated into other areas. What's interesting about that, it is directly business to consumer solutions, right? The target in this case is creating solutions for investors directly. But there is a big wave of financial technology that is coming right behind that is around actually enabling financial service companies like banks or individual IRAs or investment management firms to themselves take advantage of that shift in demographics and shift in behavior. So we're seeing more and more companies helping financial institutions serve millennials, for example, by giving them platforms and solutions that they can adopt and to do that more in a more automated fashion. So what we've seen was the beginning of that wave, and there's a big long tail of new technologies that are being developed around that.
Yeah, this is Joe. So I think in terms of where you think it's headed, if you look back at where it's been from what we would broadly consider a fintech perspective, if you think about it, we went from digital payments to financial management to lending was the really hot one up until sort of the tail end of last year, and now wealth management is the one that's really got a lot of traction and getting a lot of focus from entrepreneurs and investors. I don't know what will be the next category in fintech in general, but I think what will happen relative to wealth management is the same thing that's happening in payments. And it'll take a little bit of time, but what has happened in payments, if you think about all the digital wallet players out there that are not your typical banks or your typical card associations, they've actually now got enough scale and critical mass that they're creating their own networks. And so they're going to very quickly, at some level, obviate the need for traditional methods of money transfer, whether it's in a credit card association across ACH or otherwise. They're building their own private networks. I think the wealth management companies, if you want to apply that analogy just for a second, are actually going to start developing their own products. So it's a matter of time before, right now they're focused on getting you access to products and making more intelligent product decisions, but ultimately a lot of those firms, and they may not be the traditional players, are going to start getting into establishing new and different sorts of products that are more suited to the next generation of investors and savers.
I agree.
This is Mitch. I am in the wealth management space. Again, our service is a lot like in the venture-backed world of personal capital, where we provide an advisor, but it's all phone-based. But you got to look at the size of the companies and what's getting built out there relative to the industry. So, if you look at a Betterment and they're not yet at $1 billion and they're charging probably a weighted average of 20 basis points on AUM, that may be a $2 million a year business. And I don't know what kind of multiple you'd put on that in a public market, but the closest comp would be a Financial Engines, which I think might be at 5 or 6x of revenue, even go to 8. These companies have a long, long way to go in terms of AUM, AUM being assets under management, to get to a size where it justifies the institutional investments that have been made. As a matter of fact, if you look in the rags of the wealth management industry and you look at the size of independent investment advisors and who's the biggest and how long it took to get there, $2-3 billion is getting up into some very, very thin air in this business. So getting to 10 and 20, which is necessary to even begin to get your investors' money back, that's going to be a very, very interesting challenge. When we see companies like Betterment going to the institutional channel to offer their service on a white label basis to the traditional registered investment advisor, to me that starts smelling like the kiss of death, because that investment advisor is going to go mark up that service of Betterment and effectively bring the end user back to the same old high-cost fee structure that everyone's trying to disintermediate. So I'm a little skeptical about what I see going on and the probability for success from an institutional investment standpoint in my space.
So with just a couple minutes that we have left, I'd love to hear, just very quickly from each of you, which are the companies that you see as the leading innovators in digital wealth management? Who's doing it right? Who's got really good ideas? Mitch, let's start with you.
I think Wealthfront. I think those guys really have figured something out that's special on the customer acquisition side. They really are they figured out a way to use old school techniques. I mean, they just targeted Bay Area engineers and Silicon Valley companies, got them interested, created a gamified referral program, stoked those forces, and they're just growing without marketing expense. Okay. I think they'll leverage that into other areas, and I think it's just a magnificent model for their market.
Wealthfront, great. Stefan, how about you?
Well, I'm a little biased because many of those are our customers, but we like to think we help them achieving what they do. But certainly Wealthfront has broken a lot of the mold, and they've been very successful by focusing specifically on automation and millennials. You have other companies that have built different hybrid models that are not pure millennial, pure automation, like Personal Capital and Betterment, who are also doing very well, and others in the field. These are certainly today the firms that we see leading the field. Yeah.
Okay. Joe, how about yourself?
Yeah, I think it's hard for me to choose, and I don't want to play favorites because we power so many of them at this point, and they all have got a really unique perspective on how they're approaching the problem. Of the ones that have not been mentioned yet, I think LearnVest is on something really interesting, and they started out serving primarily the female demographic, but now they're expanding. They're an equal opportunity investment advisor at this point, but they've got a really great user experience that's kind of a hybrid between digital and live people, which works really well. So I like what they're doing. Mitch is too modest to say it, but I love what he's done with Market Riders in the past. If you want a kind of a hands-off experience and sort of a really safe track to go down with your money, I would check out Market Riders. They're doing some really interesting things. And then another one that I like, which is not so much a wealth manager as maybe it is an investing platform, is take a look at Motif Investing if you haven't looked at them yet. They're doing some really interesting stuff around how you package your own version of funds and package your own investment mix.
Okay.
Yep.
That's a great selection there. We've got literally 1 minute left in our presentation, so I'd like to advance to the next slide and just take a minute to thank the sponsor of this event, Yodlee Interactive, and thank our speakers. Mitch Tuckman, the Managing Director of Rebalance IRA, and as you mentioned, Market Riders before that. Joe Polverari, Yodlee, Stefan, the CEO and founder of XIgnite, and I am Dylan Tweeney, the Editor-in-Chief of VentureBeat. And if you have questions for the panel at the end, I think we don't have any time to get to any of your questions, despite what the slide says there. But we thank everyone who submitted questions and invite you to visit venturebeat.com and yodleeinteractive.com for more coverage of wealth management, fintech, and more information about this space. Stefan, Mitch, Joe, it's been a really interesting discussion. I wish we had more time to continue it. But thank you, all three of you, for participating. It's been really fun. And thank you to the audience members for attending, lending us your ears and your eyes, and sending us your questions and participating in the poll. On behalf of Yodlee and VentureBeat, I'd like to say thank you, and we'll catch you at our next webinar.
Thank you.
Thank you.